Welcome to the Net Profit Podcast with Ryan Kimler, your Net Profit CFO, helping business owners like you grow their net profit one episode at a time. And now your host, Ryan Kimler.
Hello, and welcome to another episode of the Net Profit Podcast. I am your host, Ryan Kimler, the Net Profit CFO. And today I am doing a solo episode. I wanted to work out some of the myths and hopefully misunderstandings around cash flow. I'm going to cover 5 mistakes that most business owners get wrong when it comes to cash flow. I've met a lot of business owners that think having money in the bank or collecting payments faster is going to solve all of their cash flow problems. That is definitely part of it, but it's not all of it. And so today I'm going to dive in and break down some of these mistakes that I see are made and really get into the details and kind of also share some solutions that will hopefully help you overcome some of the common mistakes that I see when I start working with business owners. So the first mistake that I see is confusing profit with cash. After you get down to the profits in your business from operations, there's still a good portion, a lot of activity that takes place before you get down to net cash flow or the net change in cash in your business. So when I say a net change in cash, it would be like if you pulled out your January bank statement from this year, 2025, when we got to the end of the year and you had your December bank statement, and let's just say, just for easy round numbers, your cash flow went from $50,000 in the bank. So your ending or your beginning statement balance on January 1st was $50,000. And let's say you ended December with $70,000, right? For the year, total cash increase of $20,000. We can all do that math. That's really simple. Your profits, though, if I had to venture to guess, were probably not $20,000. Okay, again, there's a lot of changes that happen between profit and cash. So one of the first ones is the timing of your sales and when things get booked versus when it actually gets collected. So as an example, you could be a contractor, you could be a lawyer, you could be a dentist, right? You issue your client an invoice. They don't always pay the same day. Could come later, right? So potentially you issue your client an invoice at the end of December and they don't pay you until January. Well, that cash is going to hit in the next year. So if you're looking at accrual reports, then when the cash actually hits is not going to be the same timing as when you actually bill your client. It's 2 different dates. And so it's possible to look very profitable on paper and also be broke if you're not collecting cash in a timely manner. So that is a very common mistake that I see with the business owners that I make or that I work with and that I come across. And a very simple solution to fix that problem is really to make a 13-week cash flow forecast based on the real payments that are coming in. So that's going to get you out of the accrual accounting that your accountant might provide and get you to what cash came into the business, what cash went out of the business, what's our net cash for the week. So that is a step in the right direction, but that also does not account for everything because you can look at your bank balance and there's still other things that are going to be happening. So that brings me to mistake number 2, which is relying on the bank balance to make decisions. That is a very, very bad method for running your business. This is also why, or one of the reasons why Profit First does not work. If your bank account is your dashboard, you are really flying blind. There's a lot of things that can be misleading about the bank balance. For example, maybe you've got pending payroll. Maybe, what you see in your account today is $30,000, but you've got $15,000 of payroll that's going to hit tomorrow on Friday, right? You could have quarterly tax payments that are due, that are still sitting in your bank account that are coming up, right? Maybe the deadline is, next week, right? So again, just looking at your bank balance can be really, really misleading, and you're really flying blind if that's the only thing that you're looking at. You also could have annual payments coming up. Maybe it's for insurance, maybe it's for softwares or subscriptions. Those kind of things are going to come out of the bank account really, really soon. And from my experience, the worst client emergencies really happen right after you feel like you've got a lot of money in the bank, right? And you're not focused on or not thinking about, running payroll and paying that tax payment and the things that are going to flow out of the bank account in the near future. So again, that's what I've seen for clients that I've just started working with. If you're running off of the bank balance and making decisions, that can be a really, really big mistake. And again, I think emergencies really happen right after your bank account hits a really, really high point, right? So instead, I like my business owners to have a dashboard, see where we're going, see what their forecast is, and really look at their operating numbers and look at, what are the results that we've really produced again, and then having that forecast and looking at what's coming up in the near future. And that kind of brings me to, mistake number 3, which is not really understanding I'll call it your operating cycle, but it's really, when does cash come into your business? When do you get payments? And then when does cash go out of your business, right? What happens if you collect deposits ahead of time? But really understanding the full cycle and the full timeline of you sign a new client or customer, you do the product or service delivery, then you bill them, and then you collect, right? In a normal circumstance. If again, you might be collecting deposits ahead of time, so maybe it's you sign a brand new customer or client, you collect a deposit for maybe a third of the work or a half of the work, and then you do the work and have some production and service delivery, then you do your billing and collection on the rest of what you haven't collected. But really not understanding kind of that timeline, that cycle, and knowing how long it is. So if you signed a client tomorrow, how long is it going to be before there's additional cash that hits the bank, right? Knowing that timeline, it could be for some businesses, it could be 30 days. For some businesses, it could be a much, much longer timeline, more like 90, 120 days, 6 months. The real extreme example would be like a car accident case that you're going to, take to court. That could be multiple years, right? Or, a big like class action lawsuit could take years to settle as well. So again, big mistake is really not understanding the operating cycle and knowing when things are coming out, when things are leaving. Even if you have really strong profit margins, if you can't survive the timeline of when you're going to get those payments, you will run out of cash, which is the end result of that is you're going to be out of business. So again, highly, highly, highly recommend understanding your typical operating cycle. Again, there's going to be exceptions, and you're not always going to follow the rules exactly, right? And it's not going to go perfect every time, but knowing your typical operating cycle so that you know what's normal, and then, you can deal with the outliers. If you're if you're running tight on cash and falling short on cash because your cycle is too long, the best thing that I can recommend there, kind of the fix, is you've got to speed up at least one part of the timeline. Maybe it's collecting deposits up front. Maybe it's billing faster. Maybe it's automating how payments are collected and helping your customer pay you faster. Maybe it's changing your payment terms if you can. Some industries, there's just the standard of this is what it is and you can't change it. That's fine. Charge late fees to encourage clients to pay on time. You could also do prepayment incentives. So, if they pay it in 10 days, they get a small discount, 2, 3%, versus if they pay in 30 days, it's just the normal bill. So that is just a few things very possible that you could do. You could tweak, again, just tweaking one of those parts could be could make a big change in your business. And now I'm going to go to mistake number 4, which is thinking that cash flow is an accounting issue. Cash flow is really based on your strategy. I think as you've probably seen here with mistakes 2 and 3, right? Not looking at the bank account and really understanding your operating cycle. Cash flow is not a bookkeeping or accounting or a tax problem. It is really a strategy problem. And one of the common mistakes that I see with a lot of my clients is just not having a good handle on, well, what is our pricing structure? Are we priced correctly? What is our billing model? How do we hire and when do we hire? That timing really matters from a cash outflow standpoint. What are our payment terms, right? All of those things really create cash flow into the business. Again, one of the biggest ones is that pricing structure and hiring timing. The two kind of go hand in hand because your payroll or your labor as a percentage of your billings or a percentage of what you charge your client is going to be dependent on your pricing and what you pay your people, right? So let's just say, as an example, you price to a customer is $100 for a service. Your labor that's involved is $40. Well, that's a 40% payroll cost, right? Again, if you move either one of those levers, if you move pricing up, let's say, that's going to dilute the labor, assuming that your labor didn't change, right? If you move labor up or down, that's also going to change, what your percentage of labor cost is. So understanding your pricing structure, making sure that you're priced right, that you can get in a good volume of clients, but it's also okay if there's a portion of clients that turn you down for price. And then understanding what your labor costs really are and the hiring timing of when you need to make your next hire and when to bring that next person in and keeping a good track on, well, what's my percentage on labor? Again, if we sell $100, what percentage is going to be paid to labor? So a really good fix for this to overcome this mistake is really just sit down and build out your model. Sit down and figure out, where do we need to be priced at? What goes into it for labor? What do we need to allocate for overhead and marketing? And then figure out what you've got left in profits. And then from there, work through the rest of the cash flow equation and figure out, does that leave us enough to have positive cash flow and continue to operate the business? If you need some additional help on looking at how the transactions that take place after profits on cash flow, highly recommend. I just did 2 episodes with Mark Delfini. We walked through a couple of case study examples, walked through the statements and how cash flow works. Highly, highly recommend going back, tuning into those, and highly recommend doing that on YouTube so that you can see the video and the actual file that we worked in. So again, really sit down, build out your model, and figure out, is it going to work? Is it going to produce enough cash before you even start selling, right? And really, that's evaluation. That should be done regularly. With my clients, I like to at least do that annually to look at what is our model? Are we priced right? Who are we going to hire in the next year? And what's the timing of that hire? Again, all really, really important for having good cash flow. And by looking at that model, you can really figure out, can I scale this, right? Can I, put a 0 behind all of my numbers currently, right? That'd be 10x in your business, so to speak. I don't necessarily love those terms, but can you put a 0 behind it? Does it work? If the answer is no, then you probably need to rework the model, right? And then that brings me to mistake number 5, which is really not predicting future cash needs. I see this a lot. Most business owners are just completely blindsided by cash problems. By the time you realize them, a lot of times it's too late. And I believe that's why we have a lot of failed businesses in America today. Growing requires cash. There's no way getting around that. Hiring, more marketing, more equipment if you have to buy it. Hiring requires cash. Again, most of the time, by the time owners realize that, it is too late. So again, if you don't model this out, you can grow broke. And that is a concept that Mark Delfini and I talked about in part 2. We actually showed a construction business growing in revenue while declining in efficiency in their profits. So it is possible to have a higher revenue number, a higher profit number, but also getting less efficient in their profit percentages. So going from, like 27% profits to 23% profits. That might not sound like a lot. You put in $1, you get out 27 cents versus you put in $1, you get out 23 cents. But again, you start scaling and you start adding zeros behind those numbers. And then all of a sudden, what if it is $270,000 versus $230,000? Or what if it's $2.7 million versus $2.3 million? I'm sure as a business owner, you don't want to just leave $400,000 on the table. So, and of course, if you keep going, it could get to $4 million, right? So really planning out your growth, really keeping an eye on your numbers, making sure that your business is staying efficient. There's always going to be periods where you're probably not as efficient as you were as you grow, because growing does take cash, right? But when you kind of do it in stages, are you getting back to when you get that new employee in and ramped up? Are you getting back to the same efficiency or better efficiency than you had before you made that hire, before you took on that additional expense, right? Or took on that additional investment, right? So again, you can grow yourself out of business and you can grow yourself into a cash shortage. A few quick fixes for that are just having monthly cash projections, having a monthly forecast, moving forward into the future. A CFO is a great person to bring in and collaborate and work with on that. I know we do that for our clients, being able to, look at their business and the things that they have going on and being able to say, well, what's going to be in your bank account 90 days from now, right? It's a great exercise to work through. Again, factor in things like quarterly tax payments, right? Factor in those planned expenses, factor in that extra payroll, especially if you're a business that runs payroll every 2 weeks, right? That's another thing that could come up. If you run payroll every 2 weeks, you've got 26 pay periods over the course of a year. Well, there's only 12 months. So if you did 12 times 2, that gets you to 24 pay periods. So having 26 pay periods means there's going to be 2 months throughout the year that you're going to have 3 pay periods in that month. And so that's obviously going to be extra cash flow out of your business. You've got to cover a whole additional payroll cycle. So those are definitely things to think about. A couple of key takeaways here as I wrap this up. Number 1, profit does not keep your business alive. Cash does. Gotta have cash. You can run a business for many years without a profit. You cannot run your business for one day without cash. And cash flow is something that you design and control based on the model that you build, based on your operations cycle and how long it takes. So those are things to keep in mind and to go and have a look at. If you are needing help looking at your cash flow, understanding what's happening in your business, understanding your operating cycle. Those are all things that my team and I can definitely help with, building out that forecast so you can see where your cash is going and what cash might look like, say 90 days from now. Again, if you need help with that, netprofitcfo.com. And until next time, everybody, go accelerate your profits. See ya.
Thank you for listening to the Net Profit Podcast with Ryan Kimler. Make sure to subscribe or follow the show on your favorite podcast app. Don't forget to check the show notes for our guest contact information and to connect with Ryan on his website, netprofitcfo.com.